It seems like everywhere we go in our daily lives, in the news, on social media, and even in the streets, we always hear these confusing financial terms. In reality, they aren't as complicated as they appear. In fact, they are more simple than they seem. All these terms are included under one heading. All that you need to understand these terms is to understand the stock market. So let's dive into it. The stock market consists of three foundations: exchange market, public companies, investors and traders. An exchange is a marketplace that regulates transaction between companies, buyers and sellers to ensure transparent prices and fair trading, and also used from companies to raise funds. Public companies. As its name implies, a public company is open to the public, meaning anyone can check its financial status and buy shares of it in the market. In case you are unfamiliar with the concept of share, it is a portion of company that you can buy or sell. The companies sell their shares on the exchange to raise money for expansion and growth. Investors and traders. Investors buy shares they see as it is potential for profit. There is a little difference between investors and traders. Investors buy stocks for the long term, months, years, or even decades. However, traders trade on daily basis using short-term strategies, trying to make a profit from price fluctuations. So, exchange regulates the market. The companies raise funds by selling their shares. Traders and investors trade shares on the exchange. Another thing you should know is the difference between primary market and the secondary market. The primary market is when a company goes from private to public to be listed on the exchange, or what we call IPO, initial public offering, where shares are created for the first time and start selling them. In the primary market, investors can purchase shares directly from the company. After that, the investors will buy and sell from one another, and this is the secondary market. Many of you have probably seen The Big Short movie and how these investors made money during the crisis of 2008. Have you ever wondered how they made it? In the stock market, there are two ways of investing: long and short. Long positions are simple. You buy expecting the stock to rise in value in the future. Short positions are the opposite. You enter the position believing that the stock price will drop in value. It works just like standard deals, but in the opposite direction. As long as the price falls, you are making a profit. In other words, we can bet stocks against our will. So, what moves the price of stocks? The stock price gets changed because of supply and demand. Increasing the number of buyers will increase the price, and vice versa. Many factors influence the supply and demand of shares, but the most important factor is a company's earnings and profitability. You should know that the price of stock does not necessarily reflect the share performance or the size of a company. At the time we are recording this video, the price of Coca-Cola share is $54.5 and the price of PayPal share is $80.5. But the Coca-Cola have a market capital of $237 billion and PayPal $93 billion. In case you don't know what a market capital represents, it represents all the shares of a company in the market, or what we call outstanding share, multiplied by one share price. In this example, the outstanding share of PayPal are 1.158 billion shares, and Coca-Cola outstanding share 4.353 billion shares. $54.5 multiplied by 4.353 billion shares equal to $137 billion. $80.5 multiplied by 1.158 billion shares equal $93 billion. That means if you want to take a look at the size of a company, you should see the market capital, not their share price. And I have a question for you. What investment type do you prefer, trading style or investing for the long term? If you find this video helpful, you can help us by liking the video and subscribe.